Pretty much everyone in the market I speak to this morning, except that this isn't about engineering currency weakness, it's about tolerating currency weakness. What are you telling clients this morning?
Hi, John. Well, essentially, it's been a bit of a surprise, just in terms of the speed. The magnitude, not too crazy. We thought a breach of 7 was going to be on the cards when the US increased those tariffs. But it's just the pace of the move. It could lead to capital flight concerns in China, which would be quite expensive for the authorities to slow down. So the message we've been giving to clients is, in the short term, we do expect some smoothing here. I don't think the Chinese authorities want things to get, again, tomorrow to have a similar move like we've had today. But the direction is you're going to see dollar China continue to creep higher. 720 is possible, 740 as well by year end. And that is on the basis of a very pessimistic view from our guys, which is that we're going to see those tariffs go up even more than we've seen already.
So, Jordan, let's be clear.
10% tariffs probably be 25.
You think that we could get tariffs ramping up to 25. You think that dollar yuan could break out to 720, 740. But you also think they can smooth that move. It's the smoothing of the move that I'm interested in. I accept, and I think most people agree, that this is about allowing currency weakness. What I sort of scratch my head out is this immense faith in the Chinese policymakers' ability to smooth things out, to make it orderly, because we saw in 2015 and 16 that things can get out of order very quickly. Jordan, do you have that faith in the policymaker to have that smooth move out to 720, out to 740?
John, I don't operate in faith, I operate in facts, which is you see when they do intervene in the market, they can make the short-term speculators take some pain. You can have short squeezes, and that leads to that smoothing, John.
What about the US side of things, the prospect of currency intervention? We've heard it a couple of weeks ago. There was a meeting on Tuesday, last Tuesday, the Tuesday before, in the White House. The president pushed back against the prospect of intervention. Jordan, the team at Nomura right now, do you think that's on the table for the White House?
I mean, it's on the table. We put around a 20% probability on this happening in the next 3 months. It's very different to when Trump became president, because he had the Federal Reserve raising interest rates. If he had done it back then, it just would not have worked, with higher yields in the US making the dollar stronger. This time round, Fed cutting interest rates and dollar intervention, it would have an impact. Short term, you would see position squeezes where people are trying to be as long dollars as they can, and therefore it is on the cards, and we should watch out for it if we see things escalate.
So, Jordan, let's get some calls in the currency market. Right now in G10, the shock absorber over the last week has been the shock absorber you'd expect. It's the Japanese yen. Have you got any big directional trades out there in G10 at the moment?
Yeah, we do, and it's all very short-term risk-off. All the trades are pretty much in that way. We've got dollar yen to the downside, looking for 105. We've got Aussie dollar to the downside, looking for 65.5. And we've got euro dollar short positions as well as long euro sterling, because we think Brexit will continue to weigh on things. So essentially, John, we see no light at the end of the tunnel for risk sentiment taking a turn unless we see decisive action from policymakers with looser fiscal and looser monetary policy, but they just don't seem to be there yet. So for right now, it's risk off, and unfortunately bad news more to come.